Hello and welcome to this joint event between ADBI and SMU, the Kee Boon Institute for Financial Economics. This will be an event focused on digital finance and sustainability. So really looking at how we can use digital finance for sustainable recovery with a particular focus on Asia. My name is John Byrne. I'm Vice Chair of Research here at ADBI. And we are delighted to welcome participants at this event today. Each day we will have a keynote speaker and 4 research paper presentations. To kick things off, I would like to invite the Deputy Dean of the ADBI, Sengju Beck, to give some opening remarks from the ADBI side. We will then have opening remarks by Dave Fernandez from SMU. Please, Didi Beck, go ahead, please. Thank you.
Thank you, John. Hello, everyone. As introduced, my name is Sengju Beck, Deputy Dean of the Asian Development Bank Institute. It's my pleasure to provide opening remarks here today at this conference on digital finance and sustainability, which is jointly organized by ADBI and the Kee Boon Institute for Financial Economics at Singapore Management University. This conference comes at a timely juncture as we seek mechanisms for sustainable economic recovery, not only in Asia, but globally. Digital transformation is central to enhancing the productivity and competitiveness of economies and driving their sustainable development. Digital finance and trade play an important role in these dynamics. In this context, sound and efficient domestic and cross-border digital payment systems are increasingly crucial for reducing inequality and enhancing economic integration. Moreover, a new strand of research on sustainable digital finance and green financial technology has emerged in recent years, the implications of which have the potential to deliver new environmental and sustainability breakthroughs. Given accelerating digitalization and innovation in digital finance after the COVID-19 pandemic, it is imperative that policymakers strike the right balance between financial regulation and enabling financial innovation. More broadly, the link between digital finance and sustainable economic and environmental outcomes is currently not very well understood by many economists lie at different stages of financial development and digital finance adoption. This conference focuses on furthering our understanding of digital finance and its implications for sustainable and inclusive economic growth. We will also gain an insight into the channels through which digital finance affects sustainable outcomes and an understanding of prevailing and future sustainable development challenges for policymakers posed by digital finance. We have an excellent set of speakers and researchers at this event, covering a variety of pertinent topic areas over the next 3 days. These will include discussions on the growing importance of fintech as a driver of increased growth and development, and the obstacles-based factors driving innovation in digital payment systems and linkages between digital finance and green growth. While our time is limited over the next day, I'm sure that we'll learn a lot through our discussions on the policy priorities ahead for maximizing the potential of digital finance for sustainable growth in the region. I will stop here. Let me now hand over to Professor Dave Fernandez of the Kee Boon Institute at SMU, who will also provide some remarks from his side. Thank you very much.
Thank you very much, Deputy Dean Beck and John. And I would say a hearty congratulations to our partners at the Asian Development Bank Institute on the celebration of your 25th anniversary. Here in Singapore, where I direct the Kee Boon Institute for Financial Economics, next year, 2023, our institute will be celebrating our 15th year of existence. So just a quick word on the origin and mission of the Kee Boon Institute. The man whose name is on the front door, Mr. Kee Boon, unlike many people who have things named after them at universities, Mr. Sim was not a large donor, and he was not a politician. He was a civil servant, worked his entire life focused on improving the situation of the new country of Singapore at that time. To better understand his life and his work, we published a book, a biography of Mr. Sim just a couple of months ago. And no less than Singapore's Prime Minister wrote the foreword to the book in recognition of his important contributions to the country. What Mr. Sim did, quite simply, was to get things done. Whatever society needed at that time, he focused on getting the best ideas available globally, but very importantly, putting them into action. And that includes signature things like establishing Singapore's initial trade relations through Intraco, to setting up the Changi Airport that everybody flies through when they visit Singapore. And we hope to invite all of you participating in this conference to Singapore in the coming year. So Mr. Sim got things done, and that's what we do here at the Institute. Our mission is led by a very high-powered advisory board of finance practitioners. And what we do is we focus always on macroeconomic trends and financial technology developments as they drive everything. But we've also decided to focus on two specific areas in the coming years. One of them is financial inclusion and education, and the other is more directly related to today's conference, which is sustainable finance. Sustainable finance is one of our focus areas here at the Kee Boon Institute. And our efforts were supercharged in the year 2020 by the creation of the Singapore Green Finance Center here at SKBI. We take a multidisciplinary approach to sustainability, so we're particularly pleased with the contributions at this conference over the next 3 days by our colleagues here at Singapore Management University, in the School of Economics, Associate Dean and Professor Tomoko Fuji, and at Singapore Management University's School of Computing and Information Systems, Senior Lecturer Randy Duran. We are really looking forward here to participating and leading these sessions today, tomorrow, and Friday. The conference, as noted by DD Beck, will feature new research on digital finance and its implications for sustainable and inclusive economic growth. And so I really look forward to the next few days and welcome you all to this conference. I'll turn it back now to my partner, John.
Thank you very much, Dave, and thank you, DD Beck, for these excellent opening remarks, which really set the scene perfectly for the event over the next couple of days, over the next 3 days. So today we will have, as I said, one keynote speech and 4 paper presentations. It will follow the same format each day. I would like to now go directly to the first keynote speech, which will be delivered by Professor Manju Puri, who is a distinguished professor of business administration at Duke University. She's also a member of the finance faculty and is on the advisory board of the Center for Entrepreneurship and Innovation. A full bio will be provided in the chat part. I don't want to waste too much time reading out the full bio, but that's available online, and we will enter the link in the chat for everybody to have a look at. So without further ado, I would now like to play the pre-recorded video of this speech, which will last for around 20 minutes. Please go ahead.
Hi, I'm going to talk to you today about the rise of fintechs and credit scoring using digital footprints. So this is work based on a publication that I've had recently in the Review of Financial Studies. And this was joint work with Tobias Burke, Valentine Berg, and Anna Gombovic. So let me talk about data and alternate credit scoring. Now, historically, there's been a large literature that suggests that banks have an information advantage over other players, whether it's public markets, whether it's credit bureaus. Banks just have access through their deposit taking and their lending to information about individuals and firms that others don't have. And hence there have been innovations such as ultra FICO scores, which basically says, hand over your bank statements, take that information and harnesses it and sort of incorporates it within the score, if you will. And now if you look at the internet, there's all kinds of data available, conventional and unconventional. What does it mean for in terms of credit scoring and the way that we should think about it? And so the motivation for our work is quite straightforward. And that is, we ask, how informative is the digital footprint? Now, what do I mean by digital footprint? I mean, it's simply the information we leave behind when we access a website. So I'm talking of a bare bones or a shallow digital footprint. Most of us know that if we Twitter or if we put stuff on Facebook, a lot of people are going to see it. But if we simply surf the web and access a website and register on it, how much information do we actually leave behind? And is that information useful in terms of predicting default or otherwise? And our research suggests it's not just useful, it is very, very useful. And this has wide implications, both for banks and their business models, of potentially for access to credit for the unbanked, and for the behavior of consumers, firms, and regulators in the digital sphere. So here's a picture that sort of describes the motivation. So if I was a woman from Mars and I knew nothing about New York, what would this picture convey? And this picture is in the public domain. The red dots are telling you people using iOS, so iPhones. The green dots are people using Android phones. And the purple dots in the middle are people using BlackBerries. So what does this mean? There's recently been some interesting research looking at what's the difference between the rich and the poor through the ages. So it used to be, do I have cable TV? Or do I have a BMW? In today's world, the difference between the rich and the poor is, do I have an iPhone or not? And so having an iPhone is an indicator for being in the top quartile of income earners. So now if you look at this, right, what do we see? The heavy concentration of red dots or iPhones in the Manhattan area. Start moving out to New Jersey and Brooklyn, you see many more Android phones, right? And so the wealth is all sort of concentrated here in Manhattan, if you will. And you can see that even if you know nothing about Manhattan, nothing about New York, this picture is basically telling you that. And as you go out to Brooklyn or New Jersey, income levels fall a little bit and you see more green dots. And what are these purple dots in the middle? So they could be, people like Obama refusing to give up their BlackBerries, or more likely, bank-issued BlackBerries, right? Now, but this is only one data point in the digital footprint. And this one data point is already telling us quite a bit about the city of Manhattan and its surroundings. And when you go and access the web or look at a website and browse, you're leaving not just this one data point, but many more. So that's what we'll look at. And so the data that we use is basically we have data from an e-commerce company in Germany, which sells furniture. So this is very similar to Wayfair. And so you browse, you like a coffee table or a chair, you order it, it gets shipped to you, and then you pay later. And so this is a little bit like a short-term consumer loans. You'll get a few reminders, and if you don't pay, then you've defaulted. The average default rate on a per annum basis is about 3%. That's roughly similar to what you see in Germany more broadly. And so it's comparable, to what you would see in Germany or US in terms of credit card debt. So in the digital footprint, again, we're going to do a bare bones, shallow digital footprint. We're going to look at 10 easily accessible variables. And I've listed the 10 that we get, and I've divided them in 3 buckets. So the first is the device type. Is it a desktop, a tablet, a mobile? Is it an iPhone or an Android? And as I said, research suggests that if you have an iPhone, that's a very good predictor for being in the top quartile by income. Similarly, if you have a paid email provider as opposed to a free email, think of Gmail, Hotmail, or Yahoo. In Germany, you have something called T-Online. You actually have to pay for it. So you pay means you have to have some income. And so these are in a rough way proxying for income, if you will. The second grouping, we've put things like channel, like how do you get to the website you're looking at? Did you type in the name or did you click on these paid ads, right? And there's a big literature in marketing that talks of impulse shopping. And perhaps not surprisingly, what we find is people who click on paid ads, they are more likely to default. Now, what about the time of the day that you shop? When is default rate likely to be highest, morning, noon, or night? And what we find is people who shop between midnight and 6 a.m. are the most likely to default, right? And so this is, they got up, you couldn't sleep, you pull out your mobile, you start clicking around. Before you know it, you've made some purchases, right? And so this impulse shopping, the personality traits that are correlated with it are not helping you in terms of default. Then there's the privacy setting and then email error. That is, you type in your email and then it bounces. So what does that suggest? Well, if it was someone else's email, you stole it, right? And so you're not familiar. That's why you made an error and it bounced. That's not good for you. Or if you're so drunk, you can't remember your email address. That's not good. And so what we find is if you see this email error and it bounces, the default rate is actually much higher. Then the last bucket that we have is the actual email address. So the research in entrepreneurship suggests it matters. Like if you name your firm after yourself, you sort of have some ownership or stake in it. So in your email, is your name there, either the first or last name, or is it something like, Sunflower 007? And so guess what? Sunflower 007 is more likely to default. So similarly, if there's a number in the email, you're more likely to default. And finally, because people, when they register, also have to put their address, we ask, how do they type it in? Do they, capitalize the first letter as civilized people do, or do they put everything in lowercase? So people who put everything in lowercase, they're actually more likely to default, right? And so this is what we have, and that is when you access and register on a website, you leave this information behind, and it actually predicts a lot. So here's a graph. So we're looking at default rate versus the variables. And let's first look at credit bureau scores. So if you're working for a credit bureau company, you'd be happy, I think. This is saying the highest decile person defaults less than the next decile, and then a lot less than the lowest decile. Right. And so that's as it should be. A lot of time and energy goes into creating these credit bureau scores. You would want them to be informative, and indeed they are. But now if I take just 2 of my digital footprint variables, I take the paid email address, which is T-Online plus Mac, as compared to this free dated email, which is, let's say, Hotmail or Yahoo, and Android. The difference in default between these two, just these 2 digital variables, right, is higher than the difference between the lowest and the highest decile of credit bureau scores. So this is already telling you that just these 2 variables in digital footprint is actually, has quite a bit of power. So let's look at this a little more formally, and we'll do this through area under the curve. And so this is well-known technology that we'll borrow from. And so we're simply doing a regression where we have, do you default on the left-hand side? So 1 if you default, 0 otherwise. It's a logistic regression. And we're going to regress it on these variables. Now, if it's random, suppose I flip a coin, right? Then it's 50-50. So if it's 50-50, then I'll have a 45-degree line as area under the curve. But if there's actually some information, so over here, the bottom 25% actually gives me 65% of the defaults, right? And so this is better than being random. So what is a good number in terms of default prediction? And so research suggests somewhere between 60 to 70% is actually a good number. So now let's look at area under the curve. For a credit bureau score, the area under curve is 68.3%. And so that's good. I said between 60 to 70 is good. And so credit bureau scores are doing well. But now if I look at the bare bones digital footprint, it's doing as well, 69.6%. So it's doing as well as my credit bureau score. Now think of all the time and effort that goes into building a credit bureau score, right? You need the people, you need to track all the loans that were made, the credit card limits, what was paid on time, what was defaulted, what was late. There's a lot of work that is required to build the credit bureau score. But how much work did it take to get my digital footprint? A few seconds, right? Once I accessed the web and entered the information, in a few seconds, I had the digital footprint, and it turns out it does as well. Now, if I combine the two, use the credit bureau score along with the digital footprint, I actually improved the area under the curve by 5.3%. So this suggests that the credit bureau score and the digital footprints are complements and not substitutes. So again, if I actually run the regression, so you can see credit bureau score, it's statistically and economically very significant. So this is good news for credit bureau scores. My digital footprint, all of the components, all of those 10 variables are economically and statistically significant. So for example, a mobile using Android has 2.86 times higher odds of ratio of defaulting than desktop or Windows. And now when I combine the credit bureau score with the digital footprint, the coefficients barely budge. So again, it suggests that they are substitutes. They're not substitutes. They are more complements than substitutes. And then finally, we find digital footprints are not a simple proxy for region, date, or age. We control for all that and still find very similar results. Now, you might ask, within these 10 variables, are there one or two variables that are particularly important for the digital footprint? So we look at the marginal contribution to area under the curve, and what we find is no single variable dominates. All of the variables are significant other than the do not track setting. The other question you might have is that maybe the income proxies, such as iPhone, etc., matter more than the others. That's not necessarily true. We're finding all components matter, not just one of them. And again, you might ask if it's something I can change once, like let's say a dated free Gmail account to a new one, as opposed to something I do continuously, would it matter? And again, we find all of these things matter. It's not, hinging on any one thing. Okay, so what do we have so far? Our evidence suggests that the digital footprint predicts, default for short-term loans for products purchased online. The question you might have will be, well, what about more traditional loan products? Let's think mortgages, for example. Now, we don't have direct data on mortgages with digital footprints, but we can do the next best thing. And we ask, does the digital footprint predict future changes in the credit bureau score? Because you have the same customer coming back, let's say after a year and buying something else. So now you have a fresh draw of the credit bureau score, right? And you can see what the prediction is. And what we find is that the digital footprint actually does predict future changes in the credit bureau score. And this is particularly true for the lowest credit bureau score ratings. Now, this actually is intuitive. Think of what a credit bureau score is. You're collating a lot of historical information, right? Like your past payments, etc. Are they made on time? So think of, I have a good job, I'm paying everything on time, things are fine. Now I lose my job. I fall into depression, I start drinking, getting up at night, pulling out my mobile, clicking ads, doing random shopping. My digital footprint is shot, and it's going to show me to not be a good credit risk. But it is going to take time for the credit bureau score to catch up with that, right? Because I need to actually take out loans, I need to default, and then it'll get compounded into my credit bureau score. And so the digital footprint captures me as I am today, the credit bureau score with a lag, and that's exactly what we're seeing in the data. Now, this company, after they implemented digital footprints, and the use of that for default rates, the defaults actually went down. Okay, so what are the implications of this? There are several implications. I'm going to talk in particular about 3. One, the information advantage of banks or financial intermediary. There's a large literature suggesting that banks are special, that they're able to access better information through screening and monitoring. And what this paper is saying is that the digital footprint, even the bare bones digital footprint, that the information you leave behind by accessing the web actually is very useful for predicting defaults, right? Which suggests that the information advantage that banks traditionally have is now threatened by the digital footprint. The second implication is, what about access to credit for the unbanked? There are more than 2 billion working age adults who don't have access to financial services. And so there's high hopes from digital footprints. Can digital footprints lead to greater financial inclusion? And we can actually test for this in the data, because 6% of our sample do not have credit bureau scores. So we can see, does the digital footprint work well? And this is important not just in developing countries, but even in developed countries like the US. The FDIC does a survey of the banked, of the unbanked and underbanked. And depending on what time period you take, the unbanked number is as high as 6.5 or 7%. And so this is an issue globally, both in developing countries and in developed countries. And so here's what we do. We look at our sample, right, who don't have credit bureau scores, and see what is the area under the curve. Now, for the sample who had credit bureau scores, the digital footprint gave us an area under the curve of 69.6%. For the unscorable people, the area under the curve is actually higher. It's 72.2%. So the digital footprint works at least as well for even the thin credit file customers, or people who don't have credit bureau scores. So this gives us hope. And then the third implication is, what about the behavior of consumers, firms, and regulators in the digital space? And there's the Lucas critique that once people are aware of, let's say, of digital footprints and how it's being used, then they may change their behavior. And if they do, then what would the implications be? Now, some variables are hard to manipulate. Like, for example, buying a new iPhone is expensive, and so you need to have income to do it. Others require change in habit. And you could argue that people who this affects the most, right? These are the addicts. Now, think about it. We all know how to be fit and healthy, right? Eat well and exercise. More than half of America is overweight, right? And so for the addicts who get up at night, whip out their mobiles and shop randomly, even if they know this, it may be very hard to change habits, right? And so people may respond to digital footprints by changing their behavior. If so, then first order, you've changed your behavior because of this. So that itself is big. But also, it may be hard for everyone to do so, either because it's expensive or costly to manipulate, or because habits are hard to change. Now, beyond consumer behavior, we might ask, what is the response of firms and regulators, right? How do firms respond? What about regulators, right? Now, the bare bones digital footprint that I showed you didn't have any explicit variables, let's say, related to gender or race, that might be called discrimination by the Fair Lending Act. However, if you had a deeper digital footprint or access to more data, maybe there are backdoor ways of getting there, and maybe these are things that one should be concerned about. And so how should regulators think about it or deal with? You know, these are first order questions that are important. Okay. So is the digital footprint useful for predicting payment behavior? And what we've shown is even a bare bones shallow digital footprint, simply accessing and registering yourself on a website, you're leaving as much information behind that will give similar predictive power for default as the credit bureau score. We also show this is a complement rather than a substitute to credit bureau scores. So using the two together is actually more powerful. And it works equally well for customers who don't have credit bureau scores. Now, remember, we've used a shallow digital footprint. There are companies that, openly use a deep digital footprint, right? So they mine social media, or in developing countries, for migrant workers, they ask them to turn over their mobiles, and they find all kinds of surprising results. So people who use the same path every day, they default less. People with large number of contacts, they default less. People who call their mother every week, they default less. And so mining a deep digital footprint, right, is going to give you even more information than just our shallow digital footprint. And so I think, this is open to research and looking at different data and environments as to how much mining you can actually do. This has potentially wide implications. So as we talked about for banks and their business model, right? And that is, do you adopt the digital footprint or not? It's potentially is a tool to alleviate information asymmetries. It gives you hope for access to credit to the unbanked. And this is something that a lot of people have their eye on. And last but not least, it has implications for our own behavior as consumers, as firms, and also for regulators. So much food for thought, and that, I hope you'll think about and take away. So thank you very much. And that concludes my talk.
We thank Professor Puri for this excellent keynote speech. She unfortunately cannot be here today, but I think that her speech was a perfect lead in to our first session. For example, Professor Puri has made some important and robust findings on the role that digital footprints can have on credit scoring and the financial inclusion implications of that. So it can clearly have implications as well for firms, households, as well as policymakers in that area of digital finance. So now I would like to commence session one. And our first paper will be presented by Yok Wang Tok, who's a senior economist at the IMF Singapore Regional Training Institute. And the title of her paper is Fintech, Financial Inclusion or Exclusion. So please go ahead for the next 25 minutes.
Right. So this paper is a working paper that is published on the IMF website as the working paper, and my co-author is Dina Heng. I just want to add a disclaimer before I start that the views expressed in this presentation and our paper should not be attributed to the IMF or its executive board. So let me just go through the outline. I will talk about my key messages before I focus on the data and the methodology and the policy recommendations. So we start with two research questions. First, an obvious one, does fintech improve financial inclusion? And I think if you ask many people, they will say yes, right? So our research gives further evidence of that. And the second question is, even if it improves financial inclusion, are there segments that are excluded? And I think on the second question, it is a less researched question, or people, may not have done a lot of work on this. So let me just start with the definition of these two things, right? Fintech, right? What exactly is fintech? And in very broad terms, you can say that it is the application of technology to financial services. And here you see that I put ATM. If you think about it, this is really the old kind of fintech, where traditional fintech, where you don't have to go to a bank. You can access the ATM from near your house and draw money, right? And on the right here is a bunch of fintech companies, and if you notice, these are all from Japan, because I was presenting this paper in the University of Tokyo earlier this year. So for those of you in ADBI, you will recognize a lot of this, like Payday and so on. Right. So we're really talking about fintech in all its guises, right? Be it payments, be it lending, which was the subject of the previous paper, and investment advice and so on, right? And the second big thing is about financial inclusion, right? And here I provide the World Bank definition that financial inclusion is really talking about individuals and businesses' access to useful and affordable financial products and services that meet their needs, right? So the key word is access and affordability, and that it meets their needs. And as I think most of us here would know, that financial inclusion has been identified as an enabler in 7 out of the 17 Sustainable Development Goals of the UN, right? So it is a big thing, and you hear many people talking about it, right? But the key question is how do you measure it, right? I'll talk about that in a while, but let me just focus on our 3 key findings. First, our regressions showed that fintech improves financial inclusion, right? And our message is you need to measure it correctly, the digital kind, right? Second, fintech is correlated with a smaller class divide and rural divide. By class divide, I mean the gap between fintech adoption between the rich and the poor. And by rural divide, I mean the difference in fintech adoption between rural or villages versus the overall population. And the third finding is that fintech has no significant correlation with the gender gap. And by gender gap, I mean the difference between female and male, the difference in fintech adoption between male and female. So the key messages are that fintech is not always inclusive, as many people thought. There are groups that are excluded. And so our paper tries to highlight that, right? And because of that, policies on digitalization needs to go beyond the digital, right? Needs to go behind the causes of why there are people that are excluded, right? And we interviewed quite a few policymakers in Asia about their awareness and what they're doing about it. And we find that the difficulty is really that no one single agency is in charge of this thing called fintech, right? and fintech really cuts into many aspects, and it's difficult to come up with a broad-based strategy, especially to deal with this gender gap and other gaps that we talk about, right? So there is a lot of need for coordination and communication between the agencies. And the second sub-message is that we need to work on the data, right? We need to use digital measures of financial inclusion instead of traditional measures like branches and so on, because when we talk about fintech, it is the digital kind, right? So we should directly use measures that are digital, where fintech is directly applied. So just to give you more color to that, there is another IMF paper that tries to separate the traditional kind of financial inclusion from the digital kind. And the data is really from the World Bank Findex, Global Findex database. And you will see that on the left-hand side here is the traditional financial inclusion index. And this comprises things like ATM, branches, the number of accounts, the number of savings accounts in financial institutions, credit card, and so on, right? So these are the traditional kinds. And you see the weights here because they were trying to construct an index of the traditional financial inclusion, right? And the way they derived the index is through using the principal component analysis, right? So that is an example of all the types of indicators you can think of for traditional financial inclusion. And the second one on the right is the fintech digital financial inclusion, which will then include access to mobile phones, internet, and the usage of internet to pay bills, the usage of mobile accounts, use of mobile accounts to receive wages and pay bills and so on, right? So just take note, these are the things that I will be using for when we talk about the device, right? And you will find that we really focus on the digital type, not the traditional type, because we are talking about using fintech. So here it plots the data from my colleague's paper. On the y-axis is the digital financial inclusion index. The x-axis is the traditional kind. In terms of the mnemonics, you will see that this is Middle East and Africa. This is Sub-Saharan Africa, SSA. Yellow means South Asia. Orange means Sub-Saharan Africa, and gray means Latin America and the Caribbean, right? So we are in the East EAP. So let me highlight this, that in terms of the digital kind, EAP has quite a high score, right, in terms of the digital financial index and also the traditional kind. But what stands out is really the African region, right, the Sub-Saharan Africa, where although they have very low traditional financial inclusion index, they have very high digital financial inclusion. And that speaks to the leapfrogging that has been taking place in Africa. Many people will know about Kenya's digital payment, the mobile payment called M-Pesa, where without a bank account, they can have access to loans and payment to help in their daily lives. Right? So let me turn to the methodology. With the first research question, we regress financial inclusion, and this is really using the digital measures of financial inclusion. So we regress digital financial inclusion on a fintech, a fintech proxy, right? And then we put in various control variables. And this is really to make sure that we sort of isolate the effect of fintech on financial inclusion. And our variable of interest is beta 2. And we want to see that whether it is, we test for the hypothesis, whether it is positive and significant. And the whole data set is really using a panel data that we assembled. The second research question about whether there are groups that are excluded. So you see the groups here, the villagers, the rural divide, the class divide, and the gender divide. And we regress that on fintech variable. So now here the variable of interest is beta 3. We want to see whether it is negative and significant, right? If it is significant and negative, it means that the increase in fintech activities would lower the divide, right? And again, we use panel data and put in a bunch of control variables. So the detailed regressions is in our paper, but we just want to summarize the results. So this first sort of row here is the coefficient on beta 2, right? The first regression. And we find that beta 2 is positive and significant on financial inclusion, right? So we also have a bunch of traditional financial inclusion indicators, and it is also positive, but it's a smaller number, right? So it goes to the point where I said that if you want to measure inclusion, you measure it but using the digital kind, because you will find that the result is higher, right? The number is higher. And the coefficient on branches, which is the traditional kind, is negative in this case. It shows the fact that a higher fintech activities will reduce the need for branches, right? So it is like a substitution effect for between fintech and traditional banking. So that is our first regression. The second one about the divide, again, these are the coefficients on beta 3, right? There's the second equation here, right? And you find that the rural divide and the class divide is significant and negative, but for the gender divide, it is not statistically significant. And that goes to our point that there's no correlation between the gender divide and the fintech and financial inclusion. Right. So to make it sort of more interesting, we asked ourselves, okay, we've been using the indices to do the regressions, but if you were to break it down into the individual indicators, you will find that, for instance, let's take a digital financial inclusion measure like made or received digital payments, right? And so this is the top, the difference between the rich and the poor, and where is the divide greatest? And if you look at this, you can see that it is in the East Asia Pacific region and the, and the Latin American and Caribbean region, where the class divide is the greatest, right? But if you were to look at the same indicator, made or received payment between male and female, which is a gender divide, the biggest gap actually is in the Middle East, right? MEA. The blue is, of course, male, and red is female, right? So the biggest gender gap is in MEA, the Middle East region.
You have 5 minutes left.
South Africa, yeah, and South Asia, right? And this is another sort of a data point where we ask ourselves, is it the case for every country? And of course, the answer is no. So here the orange shows female, and the blue shows the male, and you will find that gender the gender gap is not really a problem in countries like Indonesia and Philippines, and Vietnam is almost equal. And it is also the case that the gender gap doesn't really apply if you look at the millennials. It seems that the female has a better use more mobile payments than millennials, right? So if you really break it down, and age disaggregated data is hard to find, you will see a bit of a difference. But let's dive deeper behind the gender gap, and there are three different sort of categories of reasons, if you like. First, really the starting point of a woman is different. Women has a lower social economic status than men, which means they also have lower education, lower wages, and that also translates into lower financial literacy and lower confidence and lack of awareness. So they may have a poor user experience, which prevents them from accessing fintech, right? And the other thing is the preference, right? Women and men are fundamentally different. Women may be more risk averse and has more concerns over data privacy. This is according to some papers like the one from BIS, and which find that women are more concerned with data privacy. But the evidence on this is really mixed. There's another Norwegian study that shows that there is really no difference, but women perceive a more lack of control over their data. And the other thing that could happen is because of product design, right? And the third group of factor is the cultural norms. Women tend to take care of the smaller daily budget, but men takes care of the bigger financial decisions. And in some countries, women really lack the freedom to access financial services. And for instance, in India, the woman cannot get a loan because they need the husband's signature, or they don't even have property rights, right? So all these gels with another recent paper from the IMF that finds that gender gaps are highly related to higher financial and digital literacy of women, and that social cultural factors also play a key role. So I just want to throw light on, how people begin to get more aware of this and develop female-centric apps like this one from Singapore. It's called Lucy. You can click on this to look at what it does. And it really focuses on women in terms of budgeting, digital payments, and charitable causes, right? So the paper really throws light on this fintech gap, and many other studies have looked into this issue. Sorry to speed up. I will just end with my recommendations. For the starting point issue, we need to level the playing field, by improving financial literacy, working across agencies to look at the various factors that inhibits women from progressing. The second factor is that you need to really provide dispute resolution channels, grievance channels to air concerns that could possibly address these privacy concerns of women. And the third cultural norm factor is a bit harder to close. Of course, designing products for women is one, right? So just to end off with the summary, that we think that the fintech, of course, is good. It improves financial inclusion, but don't forget the excluded groups, and don't forget that policies needs to address this group of people who are excluded, right? So let me just end here. I won't repeat all that I have said. I know my time is up, and thank you very much for listening.
Thank you, Yoga, for excellent presentation. Also very timely. Very relevant paper with very interesting findings. I think it's a difficult topic in terms of identification, and yeah, I hope that we'll have some more discussion in the Q&A. But now I would like to invite our discussant of this paper, who is Jonathan Batten, Research Dean at the School of Economics, Finance and Marketing at RMIT, Australia. Jonathan, please go ahead for the next 8 minutes.
Thank you. So the paper examines the role of fintech in financial exclusion. We've had, there's references in the paper about what financial exclusion means. The literature on fintech itself is vast. And I just make I just provide some information for you, in fact, on papers in Scopus that use, that are linked in with, if you look at this sort of search terms, you can see that a lot of them are technology-based papers on blockchain, machine learning, and fintech. And so the question really then from, like in terms of the overall perspective, is how financial inclusion fits into this, and whether or not the paper itself is on financial exclusion and how fintech may or may not help, or whether it's on fintech reflecting on financial exclusion. That simply matters in terms of positioning, but also in terms of much of the literature that is referenced in the paper. So the paper asked one of the first questions is, what is fintech and how does it provide these social benefits? And this is an area that could be picked up further. And so is it about fintech being a competitor to banks as a financial intermediator or intermediation disruptor? And there's a number of papers that I can suggest to you that pick up those sorts of themes. They're not necessarily recent ones, but ones that have been around for a few years that tackle these sorts of questions. The paper uses a panel regression of the Findex data and emerging fintech's indicators. And this leads to the key finding, which is the first one, about the positive correlation with financial inclusion. And this is linked in with and a stronger relationship than what is evident with traditional measures of financial inclusion. Now, just as an interesting question, looking at the indices, I'm not quite sure why there should be a stronger relationship. I certainly believe there is one, and is this to do with the way that the construction of the indices themselves being highly correlated with the individual components? The panels seem to have very high R-squareds. That's just as an econometric point of view. And this may be linked with the variables themselves and how they were and what was used. So you may have looked at transformations of the variables to address issues of stationarity. There's certainly regulatory change has taken place over time. And so these are areas that could be looked at further. With vis-a-vis correlations, obviously there's the overall correlation is static, but it might be nice to look at subgroups or subsamples to provide some more interesting insights. So question 2 is, how does the Findex data and emerging fintech data compare? So you described that there. And so, for example, a comment on table 2, the number of bank branches is highly correlated, which from my point of view would make sense. But why are bank branches, so this is a separate question, why are bank branches so important for financial inclusion? And there's obviously heterogeneity within the sample because, for example, there's China is there. So the economic impact is not especially captured by a single country variable. So it's possible that looking at subgroups might provide some more insight into that. And as I mentioned before, was the data transformed perhaps in some way due to things such as to capture the variations. And the positive correlation is also supported by these measures in areas of limited data availability. So with continuing on that story, with the digital divide, you mentioned about the SDGs. I added this second point, and certainly the SDGs is important, and there is a huge amount of literature tackling the UN SDGs, and I think perhaps in your discussion at the end you may want to pick up on those points as well. Now, rural communities are generally poorer, less educated, have less access to technology than village and urban-based communities. And so simple technologies such as electricity and cell phone access may not be available. So alternative technologies such as solar cells and so forth that provide electricity to these poor regions may in fact be part of the sort of story, and maybe things that can be picked up in terms of discussion. The conclusion then is, of course, the first main conclusion is that fintech alone is not sufficient to close the gender gap, and this is something that's very, very important, and it's a very important result. I would look. It's the way I personally am a huge fan of the UN SDGs, and I like to promote the sort of linkages where possible, but it might be nice if that was also the case here. So am I, okay. And this leads to the next question about why this is the case. So fintech development may not, I can't quite read my own slides actually, so just may need to be complemented with targeted policy initiatives. And this discussion could be further expanded, and there's a couple of links there to papers that discuss this issue. And yes, certainly discrimination is more likely to be, that to me is an obvious one. And the social norms that you've mentioned are obviously very critical. And I just, this is a colleague of mine at a university I worked at before, and he highlights the importance of schemes such as violence against women. Being able to reduce violence against women has huge impacts on such things as microfinance and so forth. So these are things that could also be spelled out. Now, there have been a series of papers published in the finance literature, specifically in the Review of Financial Studies, that look at this role of fintech, and you might be able to look at those as well. And that's it. And I think I'm 30 seconds within my time. Thank you, John.
Thanks so much, Jonathan, for a very comprehensive set of comments. I would like to actually ask Pradeep Panti, who I see has one question in the chat, to ask his question now, and then I will hand the floor back to Yoke to respond to the comments of Jonathan and the question. So Pradeep, please ask your question directly. Go ahead. Activate your camera.
Thank you, John, for this opportunity. I think my question is touched by some of the discussion points of Jonathan also. And my question is, in case of like in second equation, I think it's very interesting equations to have in your paper. I found that you have controlled your regression per divide in terms of like regulatory quality, trust index, and education to define like gender inequality index. But have you controlled your equations with income per capita? I think income per capita may explain some part of like the rural versus urban, their access to electricity or some other types of factors also. So is there any site that you touch on income of those participants on your data set or not?
Okay, thank you, Pradeep. Now, Yoke, I would hand the floor to you for 2 to 3 minutes maximum. It's very difficult for you to deal with all the comments, but please try to do so. Go ahead. Thank you very much. You're on mute.
Can you hear me?
Yes, go ahead.
Yeah,
thanks.
Hi. Thank you. So first, thanks to Jonathan for a very, very extensive and very useful comments on our paper. So really appreciate it. So let me first address Pradeep's question. Yes, income per capita is a usual kind of control variable, but we didn't use it because we tried it and it didn't really work as well as the rest of the control variables. So we sort of dropped it in the end. And turning to Jonathan's point, you made sort of many sort of comments, but I'll just address a few. On the high correlation between the right-hand side variable and the dependent variable, I just want to explain that the fintech proxies are actually from PitchBook, which is the amount of capital raised, right? So it is not part of the financial inclusion indicator. The second proxy that we use is from the Cambridge Center of Alternative Finance, and that is really about peer-to-peer lending, amount of volume of funds raised. So again, it is not correlated with the fintech financial inclusion. And the third one is the number of cell phones, mobile phones divided by fixed line phones, and it's a variable about leapfrogging, which people tend to use. And I admit that is maybe a bit correlated from the digital mobile access kind of indicators, right? But it is already scaled by something. The correlation, if you look at the results, it's actually not that high for most of our regressions, right? It ranges from the first set of regressions. It ranges from well, I think you're talking about the first set. The second set is actually not that high, and I think because it is an index, and because we did test for things like stationarity and all that, and I think it's also because the number of observations in some cases is really limited, because some of the indices only has 2 years of data, right? So there's a problem with actually having too little data, and the number of observations shows that is not as ideal, right? But we hope that when we get more data, then we could improve on the results, and taking into account your comments, I think we could do a better regression in the future. But I think we just wanted to throw light in the first place about the need for also data to be better, to be more available. And I think in this area, gender disaggregated data and age disaggregated data is really needed, right? And I shouldn't even have to say that the time, if you're running a regression, you will hope to have a time series, right? Which is again difficult to have, right? Yeah, and I agree with the point that we should link it to the SDG goals, because one of the SDG goals is really on achieving gender equality and empowering women, right? And I really like that point. Yeah. So let me stop here. I hope I have addressed enough of your comments. Thank you.
Thank you.
Thanks so much, Joachim.
One comment, John, or not?
Yes, go ahead. Yes, please. Yes.
Thank you. So thank you, Joachim. It's a lovely paper, and it's so timely, and these issues are so important. And there's been a lot of, in the science literature, for example, in Nature, the journal Nature, they've run a series of editorials highlighting the fact that there is so limited work that is being done, research work, on issues broadly to do with the SDGs. But your paper does add to it. Just prior to COVID, I was living in the north of Malaysia. And if you go into the remote communities there, one of the key things that I was very much aware of being there was the fact that you had apart from no electricity to many of these remote communities, the cell phone towers were just simply, you had no, so even if you had a mobile phone, you could not really use it because there was no coverage. And so the village people would have to go into the people living in remote locations in the kampung would have to go into the towns to do their banking. And so this was a huge impediment. And it's so in terms of even addressing this issue of financial inclusion, you need to be able to have the provision of technology, even a simple thing as to use a cell phone. Thank you. That's all I was going to say.
Okay, so thanks very much for a rich discussion, and again, thank you, Jonathan, for these excellent comments. I hope they will be that they will be able to be incorporated into the revised version of the paper, and we look forward to seeing that. Before moving,
sorry,
yeah.
I just want to catch Jonathan. Could you send your comments to me?
Yeah, sure.
Or through the
yes.
organizer? Yeah, thank you.
We will distribute the discussion slides to all of the presenters, so don't worry about that. No problem.
Yeah, all right.
Yeah. So yeah, before we go to the next paper, I wanted to ask everybody, could they open their camera, please? Because I want to take a quick photo. I'm aware that some people, might not be able to stay for the entire event, so we will try to do a photo now and put it all together, Photoshop style, at the end of the conference. So it looks like we were all together. So can someone from SMU take the photo, or somebody take it?
Sure. Can we get everybody to turn on their cameras, please?
Yes. So whoever is here, please turn on your camera now. So you can tell us when you want to take the photo.
Okay, we're just waiting for a few more people to turn on their cameras.
Okay, so if they're not here, we'll do another photo at another time as well. Let's just do whoever is here now.
Okay. Okay, 1, 2, 3. Just give me 1 second.
I'm trying to get some better lighting.
Yeah, it's not.
That's it.
Okay. Now get it. Jonathan has some better lighting now. So if we can take another one.
Yeah, we'll take another one.
Okay. So go ahead.
Okay, 1, 2, 3.
Okay, is that it?
Okay.
Okay, great. Okay, thanks very much. So now let's move on to the second paper of this session, which will be presented by Sungita Rashid, who's a lecturer at the Assumption University of Thailand. There will be a discussion by Rishi Man Rai, who's an assistant professor at the Amity University in India. The title of the paper is The Impact of COVID-19 Movement Restrictions on Financial Inclusion in Bangladesh through Mobile Financing Services. So please go ahead for the next 20 minutes.
Okay. Can you hear me properly?
Perfectly, yes.
Okay, great. Thank you so much. Good morning, all. Thank you so much for giving me the opportunity. Let me share my slide. Okay. So as John already mentioned about my name and my working, I'm Dr. Sanjida Rashid, and I'm working as a lecturer at Assumption University. And this is my paper. So let's jump into the details. Since I have only 20 minutes, I'll try to be as quickly as possible. I'll try to go as quickly as possible. Okay. The paper that I'm working to currently, this is a working paper, and the inspiration I get from the recent data that I saw, recent trend that I saw in mobile financing service in Bangladesh. So like any other least developed country, financial exclusion is a major concern for Bangladesh development. And according to Global Fintech data, around 47%, 2021 data, around 47% Bangladeshi people don't have any access to any formal banking. So government is trying their best to remove that impediment. Those who know our country is currently standing on the verge of graduation. So this is like a nerve-wracking problem right now. So government of Bangladesh, the Ministry of Finance, declared on August 25th, 2021 that they will try to achieve, they target to achieve 100% financial inclusion by 2026. Later on, following to that comment, the Prime Minister ICT advisor mentioned that on November 2022, that government is trying to build a cashless society by within next 2 or 3 years. So their target to achieve that 100% financial inclusion is mostly based on mobile financing service. Before jumping into discussion, let me walk you through a brief history of mobile financing service of Bangladesh. This service was launched in Bangladesh in September 2021 by Bangladesh Bank. The idea was to provide secure, low cost and prompt banking service to the marginalized people who doesn't have any access, or most likely located in the robust area or remote area of the country. MFS provides a lot of service, including payment service like cash in, cash out, payment transfer between person and business, payment transfer to and from government, remittance transfer, etc. But even though it was launched, it is running for more than 10 years, this service was not very popular among the people of Bangladesh. Let me show you a graph here. So this is, I picked 3 types of transaction. P2P here is the second chart is P2P, that is person to person transaction. P2P is person to business transaction, most likely utility payment, and this is remittance transaction. And this is the total transaction. Everything is in million Bangladeshi taka, million BDT. So you can see, and the red vertical line on each graph is the month that of March 2020, the official month where first movement restriction order was launched. You can easily say that before that order, the usage was almost, the growth was not actually catching up. But after that restriction, there is a huge spike in the people usage. Obviously, because of the restriction and everything, the people didn't have any other choice to rely on mobile financing. So what this paper will do, I aim to find out whether this is a one-time shot that people, as everything is now back in normal, people will go back to being business as usual, pay using cash transaction, or they already developed a habit, whether there is a paradigm shift, they started using, they will start and continue to use mobile money or e-banking, e-money system. So I will try to examine that how COVID-19 movement restriction has influenced the financial inclusion of Bangladesh, both in the short run and in the long run. Okay. The data that I used, even though I mentioned there are a couple of services that the people of Bangladesh can avail through mobile financing data, but I targeted only 3 of them. The idea was to gather as much information as possible, wide range of data, and also the most popular services or transaction. So based on these 2 criteria, I selected these 3: person to person, person to business, and inward remittance. Even though cash in, cash out is also very popular, but data set is not available for that longer range. These are even, like I said, I want to find out whether the COVID-19 movement restriction has a long run and short run influence on the payment mobile, on the MFS demand in Bangladesh. A lot of variable macro and socioeconomic factors can impact that other than COVID-19. So I included bunch of supply and demand influencer as a control variable suggested by literature. Here, every time series data is transformed into logarithm because of stationarity issue. Let me go over real quickly these variables. P2P, as I mentioned, P2P is person to person. Everything is in natural log. P2P is utility payment. Remittance is also in natural log. I added money supply because it is an index. Literature found is a very good index of seasonality and growth. Unemployment rate is also a very good indicator of mobile money demand, but unfortunately in Bangladesh the data is recorded annually, so I needed monthly data. So I used wage index instead of unemployment rate. Number of agents proximity is also a very good indicator, which was found in literature. GDP is very, very good indicator of demand or economic growth of the country, which will influence the mobile money payment. But again, in my country, GDP is recorded most likely annually. Some years I can find quarterly. So I had to use general index for production, which is a monthly data. The next variable is dummy variable, that is DC19. This is the COVID-19 dummy variable. It takes the value 1 when in a particular month there was movement restriction order more than half of the period. Like any other country, in Bangladesh also movement restriction was off and on throughout the period, depending on the number of infection, number of death, and so on. So in each month, if I found that there are more than 15 days of movement restriction, national order movement restriction throughout the country, not any particular region, throughout the country, that month took a value 1, otherwise 0. The next thing that I control for is the dummy variable to capture the festivals. So festivals also found to have a strong influence in mobile money transfer. So I added a dummy variable here. In my country, there are two or three major festivals, Eid, Puja, and Christmas period. So I added religious and cultural festival. These are the dummy. So in each month where there is any major religious or cultural festival, I added the value 0. I added the value 1, otherwise 0. Okay. Now let's talk about the methodology that I had applied. As a regression methodology, I used autoregressive distributed lag model to capture the both short-run and long-run influence. The major reason to use this methodology is, first of all, it's suitable, really suitable to have, if you have a smaller data set, this is very useful method. So since my data point has only 66 data set, so this is, for me, this was the most suitable method. The long run model can look like that. So I'll go over real quickly. What does this mean? The change means the first difference operator. To run an LRDL model, the data set has to be stationary. So even though I took log, this is the first difference. And the N1, N2, N3, these are the lag length. This lag length is based on AIC and BIC criteria. And in the equation, the first coefficient, that is beta 0, beta 1 till beta 6 are the short run dynamics, and later on that V1, V2, V3, and V4 will represent the long run relationship among the variables. Before running LRDL model, I need to test the bound test. I need to go through the bound test approach. This will indicate that whether there is a co-integration relationship between the variables. So the idea is, the hypothesis is, VI, all the coefficient of the long run variables, they are 0, and the alternative is at least one of them are not equal to 0. Even though I included the result in my original paper, the variables actually has co-integration relationship. To include both the short run and the long run dynamic coefficient, I need to use an error correction model. This is basically comprised of both long run and short run impact at the single equation, in the single coefficient or single regression model. So here, in this equation, the most important part is the delta, the ECT, error correction model delta. It is supposed to be, delta is called the adjustment parameter, and it is expected to be negative. So it will tell you how fast the current difference in mobile money transfer or MFS transaction respond to the error correction, how quickly the error correction term go back and corrects itself to the disequilibrium. Now look into the empirical result. First, the econometric result of the long run variable. Here, even though I'll talk into the sign first, even though the industrial IPI, that is industrial production index, has positive sign, but it's not significant for it's only significant for P2B, that is utility bill payment, and only 10%. So IPI has a long run influence, but the coefficient is, you can see that the coefficient is not big enough. Money supply has strong positive coefficient for both P2P and P2B. Agents has negative long run impact for P2P. The most important result that we want to check here, how the movement restriction dummy has influenced both P2P, person-to-person payment, and utility bill payment and remittance. We can see that person-to-person payment has positive and significant impact. Same result has for P2B, but even though remittance has positive result, coefficient is positive, but it's not significant. We found the same result for festival dummy also. Look into the detailed model, that is error correction model. The first thing that I want to show here, the sign of error correction term, that is delta. So it is negative, and throughout for all the variable, it is negative and significant. The next thing is the dummy variable of COVID-19. That is, it is positive for P2B in the short run. That is, COVID-19 has a short run impact on person-to-person payment. It also has a positive impact on utility bill payment, but it didn't came. The result isn't significant. But for remittance, it is positive and significant. Now, what this result mean? In the long run model, this coefficient 1.75, as P2P is in the logarithm term. So in the long run model, it means that if movement restriction has influenced person-to-person payment by 19 point, let me check the number, by 19.12%. If you take logarithm and convert it, the result shows that movement restriction has influenced person-to-person payment by 19.212% in the short run. Same thing for utility bill payment. It says that for utility bill payment, movement restriction has influenced the demand for utility bill payment by 6.28% in the long run. Even though for remittance, the result is not significant, but the result shows that the movement restriction has increased remittance, inward remittance by 15.8%. I also perform several diagnostic checks here for example, adjusted R-square, W-Watson test for W-Watson test, and white test for heterogeneity, W-Watson test for serial autocorrelation. So the result shows fairly straightforward, and it's not that severe. There is not many severe problem in the regression. To show that whether my result is actually pass the 95% confidence interval test, I perform this sectoral. I perform this cumulative sum and cumulative sum square of the recursive residual plots. So here, for each of the series, you can see the error residual is actually in between the 95% bound, 95% significance bound. Okay. Now, what does it mean? Even though I mentioned I started my presentation with the statement that government is trying to achieve the target of 100% financial inclusion by 2026, and looks like they're mostly relying on the mobile financing system, that is cashless. They're trying to achieve that 100% financial target by cashless society, by making it cashless society, relying mostly on mobile financing data. COVID-19 has a very strong impact on that. So P2P, and even the result shows that person-to-person payment and person-to-business payment has increased significantly increased 19.12% and 6.28% in the long run, and remittance has increased 15.8%, even though not significant. Cultural and religious festivals are also found to have significant impact. So the result indicates that government, even if this is the target of government of Bangladesh, the delayed COVID-19 has already laid the ground. So government should cash in this opportunity and keep the momentum ongoing. The more emphasis should be put on the success stories, emphasizing the success stories. For example, government started digital wage program during the COVID-19 pandemic, which actually showed a tremendous success in enhancing financial inclusion for garments worker or people with low earning people with low earning, those with low earning people. However, when the wage support ended in August 2020, the number of digital payment fell by 56%. This is a study conducted by Policy Research Institute, a renowned think tank of Bangladesh. Also, there is another success story that government started paying government assistance and social security allowance through mobile financing service. So especially this package is targeted for marginalized people, especially Chor people who are located in Chor area, Chor dweller. So this also has a significant improvement in inclusion, in financial inclusion for those people. However, there is a problem. The same research of Policy Research Institute, the same study of Policy Research Institute, they found that the people of those Chor area, they are not the frequent user of that mobile MFS account, because the problem is when government allow this safety net, when government distribute this safety net program, the recipient has to register for only those accounts which the state agencies approve. So recipients are not free to choose from any MFS providers. There are more than 12 MFS providers in Bangladesh, but government, the recipient of those services are forced to choose only those services which are approved by the state agents. So what happened? The recipient of those assistance, they only use those accounts to receive the payment. After that, their account remains almost inactive. So they don't do anything other than getting money from the government. So this cannot be the scenario. If government is targeting to actually achieve 100% financial inclusion, the people should be allowed to choose their own and preferred mobile financing account. Government should put more emphasis on inactive and barely active account. Study shows that in the same study that I'm referring, Policy Research Institute study, the study shows that only around 60 million out of estimated 110 million account are now currently inactive or barely active. So having this huge burden of inactive or barely active account cannot really portray the 100% financial inclusion target, or cannot really achieve the financial inclusion target. So showcasing the success stories, assuming the registered account or registered customers are actually the frequent users of MFS or mobile financing service, government should put more significant attention towards the volume of inactive or barely active account. What are the reasons for those inactive accounts? How we can reduce the number of inactive accounts? How we can improve the number of more active accounts? What are the policy instrument? What policy instrument can be helpful to increase or to lower the number of inactive accounts? Financial inclusion using mobile banking is never free from challenges. In a country like Bangladesh, there are trust issue, there is internet issue. In a lot of areas, there is barely an electricity. So internet connection is too much to ask. So in those settings, if government is trying to achieve 100% inclusion using mobile financing service, they should be more careful how they calculate this 100% financial inclusion, not just registered account. Are they active account, or are they using this account frequently on their daily basis? Like I said, COVID-19 has already laid the groundwork. Now, authorities has to just start working promptly and efficiently. Thank you so much. I hope I finished on time.
Yes, excellent. Thank you very much, Sagita. Excellent presentation on time. I think you have made a number of very interesting findings, and I would be interested to see whether these hold across different age brackets of the economy. So, you showed that the movement restriction has stimulated a shrinking of financial exclusion through the use of digital payments, but to what extent this would hold across various age categories. I'm really talking about the digital divide issue here. But anyway, let's return to that in the Q&A. I would like to now invite the discussant for this paper, who is Rishi Manrai, who's an assistant professor at Amity University in India. So please go ahead, Rishi.
Thank you, John. I hope I'm audible.
Yes, it sounds good.
Okay, great. So before I start with the presentation, I would like to thank the organizers and the conveners of this very important and very interesting conference on digital finance and sustainability. And I must congratulate Dr. Rashid for an excellent work done. So moving on to my presentation, let me share my slides. I hope it is visible. Great. So as the title of the paper was Impact of COVID-19 Movement Restrictions on the Financial Inclusion in Bangladesh through Mobile Financing Services. So the paper basically analyzes the long-run relationship of movement restriction orders on the financial inclusion through mobile financial services. The method used was auto regression distributed lag model, and the time period taken was from December 16 to May 2022. The paper also explored the influence of macroeconomic and seasonal factors of MFS demand. The result confirmed the crucial role that movement restriction order plays in financial inclusion through MFS. It also emphasized that the government should also help, or the government should develop strategies to maintain this movement and expand more on mutual fund MFS access to accelerate levels of financial inclusion. So I would first like to highlight what are some important aspects of this paper. I personally read this paper very carefully, and I think that the paper was very well articulated. The introduction part is very well explained, and the citations are very relevant, all those papers which are mentioned in the reference. The problem layout is also done very, very appropriately. I'm very satisfied with this. Of course, the data analysis part, definition of all the variables is done very carefully, and all the dependents and independent variables are also chosen very carefully, specifically the proxies and the indicators which has been taken. I'm very satisfied with all those. The tools used in the study are also appropriate, and analysis is also accurate as per my knowledge. Okay, now as far as this is the overall review of the paper, now I would like to discuss some of the concern areas of my paper. The first point is that I'm very much worried about the conceptualization of the paper, which is not very appropriate as per my understanding. The paper talks about the effect of pandemic, which is once in a lifetime phenomena, whereas the financial inclusion is a long-term macroeconomic issue. So I think mostly when we consider these type of studies, the behavioral phenomena, which is as we say that financial non-inclusivity is a behavioral phenomena. Okay, and it should have been dealt with primary study instead of the taking the econometric study or taking these macroeconomic variables, because most of the studies which are dealing with the financial inclusion, they talk about the variables such as facilitating conditions or the behavioral aspect of the people, because we all understand that government is emphasizing all the government of major developing countries, they are expecting that their countries should have maximum financial inclusion. But again, why people are not on this track, on why people are not actually taking up financial inclusion? So this is definitely a behavioral issue. Usually these studies avoid the data collection during these critical times such as pandemic, war times, etc. Because financial inclusion is a policy matter rather than and which basically changes in the times of catastrophe. For example, let's say the author was emphasizing a lot that the after this particular pandemic, and the people were basically they are actually forced to use this because they don't have any option. So when you are forced to do anything and then you are basically checking the behavior, it makes less sense to me as compared to doing it in the normal times, because ultimately we want the people to use these fintech services in regular time instead of just on those particular years of restriction. Next is about literature review. So there are certain shortcomings of literature review. So the author has mentioned this particular stance that the studies aiming to understanding the impact of an economic shock is scarce. So I just took up this line from your paper. Now there are several papers. I've just mentioned two papers over here. One is by Ozili 2020, which is again talking about financial inclusion and fintech during COVID 2019 crisis, policy solutions. And again, Yamada 2022, the COVID-19 pandemic remittances and financial inclusion in Philippines. So there are various instances, there are various countries where research have been undertaken on the similar topic. So I think you can go through these papers. They will be really helpful to you, right? Then again, the conclusion part is actual area of concern, which is extremely poor. Ma'am, you have mentioned very contradictory statements at numerous places. Okay, and it also seems that the conclusion part is somewhere not derived from your research work. Okay, the conclusion is a culmination or combination of different studies. Okay, so when we are concluding a paper, which you have actually done you've done a good work in your paper, so the conclusions should be drawn based on your research. For example, we say that COVID-19 pandemic is an unfortunate but unique natural experiment to assess consumers' response towards mobile banking transaction. So, I mean, through this statement, do you want to say that we can continue with this type of, because ultimately, if you are trying to understand or trying to take the impact of one negative environment or situation, we cannot emphasize, or the policy recommendation cannot come from this kind of statement that yes, this kind of situation should continue. Okay, so we have to understand the meaning or each line which we are writing in the paper. Then we say that the positive attitude of general people towards MFS have virtually shifted total transactions to 103% from 2018 to 21. So I have, if you see the slide, I have highlighted this word attitude again, because you yourself have said that this is the attitudinal issue. Okay, and on the other hand, when you are taking the variables, it is completely non-attitudinal. Right, so it is definitely an attitudinal issue, and you should look more towards the attitudinal aspect. Again, in the conclusion part, you have mentioned that since sustainable and impactful financial inclusion through digitalization and innovation is an ultimate objective of Bangladesh government, movement restrictions orders have certainly worked in a natural pull factor, drawing people to MFS. Government should cash on the opportunity and keep the current movement ongoing, expand access by emphasizing the best practice strategies. Now, again, the question is, what kind of strategies? As a policy, as a researcher, the role of the researcher should be to help people or to help the government, give suggestions and recommendations that these are the ways you can change. Okay, because you have done really good work, and on those basis, you could have recommend certain strategies to the government that, okay, you can do this or you can improve this, so on and so forth. So this is also one thing. Then again, a contradictory statement. You said that digital wage support system, you were talking about this, and unfortunately, another statement in the same paragraph that unfortunately, after the government wage supported ended in August 2020, the number of digital payments fell around 56%. So again, these two statements are contradictory. So if there was something good which is going in your country or in Bangladesh, and it has been stopped, so what actually the impact it is creating? Okay, or how is this related with the study? Okay, because if something is doing good, it is creating a positive impact, and you are not able to catch that, and ultimately this trend is going downwards. So again, this suggestion or this kind of statement is going against the theme of the paper. Okay, some components which I think are lacking in the paper. Contribution of the paper to the body of literature. It should be theoretical contribution should be mentioned in the paper. Then contribution of the paper to the industry, because in the initial slides when you are making the presentations, you said that the government is trying to implement the financial inclusion policy, but it is more relying on the financial service providing companies. Okay, so there should have been some message to the financial service providing companies that what should they do so that people should adopt MFS more. Okay, so again, for policymakers, the learnings or the suggestions were very few. I could not find very suggestions for. Similarly, the learnings for service providers. Okay, so all these aspects could have made your conclusion part very, very strong. Okay, because ultimately, if you have done a good research, the conclusion of the work should also show the contribution, right? So these are my certain suggestions, and that would be all from my side.
Thanks very much, Rishi, for a very comprehensive set of comments. I think you make a very important point about the sustainability of the financial inclusion gains that have been achieved over the last few years. So that's something that perhaps can be drawn out in the paper, as well as my earlier comment about the issue of the digital divide. There's a comment in the chat by Jonathan about linking the paper more to the literature on financial inclusion. So given the time, I would like to invite Sangeeta to spend 3 minutes summarizing her view on the comments received by Rishi in particular, and any other comments that you may have. So go ahead for 3 minutes. Thank you.
Hi, thank you so much, John. I like the suggestion that I can include my paper in terms of financial inclusion literature and how. Thank you so much, Dr. Rishi. Very extensive comment. First of all, I understand that what you are asking. This is really a behavioral issue. People, like the curve literally shows that people are not using. They are not using mobile financing service before COVID-19. They had to. But what I tried to find out with my limited data point and limited resource that I have, how this shock can impact, have a long run impact on this behavior. Obviously, this is a not short period. 2 years of COVID-19, 2 years almost on and off movement restriction. Some people will have that, will continue that adoption. Like I started when I'm in Bangkok, I never used cash. I never used anything other than cash payment in my country. But since I'm in Bangkok, I pay everything with mobile. So this is like a behavioral change. So what I want to check is whether there is a behavioral impact on this shock. Second one, what you what you suggest is very, I mean, it's very important. I know, but data availability is very important. This is one of the major hindrance for me. Data availability is not there. I could definitely link that with mobile connectivity, and internet uses, the cost of mobile users, whether there is an impact, or maybe those banks, are they offering some welfare or some packages? If you use my service, you will get some benefit. Those data are not available. So I could definitely use them, include them as a demand supply side impact. So if, say, for example, Bragg Bank started to offer some benefit package, if you start using mobile financing from Bragg Bank, you will get some benefit. So these long-term data or the time frame that I'm using data is not available. So I could not link that. And the last point, and that you said that wage benefit, government wage benefit. This is like a success story. Government should continue this. Why on earth they stop this? If government targeting to achieve 100%, and if they see that, okay, this is increasing my registered client, this is increasing my financial inclusion, why you stop it? You should continue that. You should focus on more. You should open more channel, not just stop a successful channel. This is not a policy. Shouldn't be a government's policy. Okay, focusing on success story is the best way to increase more channels. And what government is doing at one instance, they are targeting a target which is, to me, it looks like completely unachievable. At the plus, they are stopping those channels which could help them to reach through the target. So that's why I made, yeah, I know this is contradictory, but that is what happening. So everything is kind of contradictory. So what I tried my best is to bring up those that, yep, your policy or your target will not work if you have a couple of success stories, and if you stop that, you can never reach there. You're planning to reach there, the how you're planning to reach there. That would be all. And if I can get the comment, I can really improve my paper.
Yes,
Thank
we
you,
will
Dr.
distribute.
Rishi.
Yeah.
Thank
Okay,
you, Dr. Rishi.
Sorry. Thank you very much, Sangeeta, for your response to the comments and questions. As I said earlier, all of the presenters will receive the discussion by email, so you can have a closer look at the comments received then and make the changes to the paper accordingly. We will now have a little break. We're slightly beyond schedule on the agenda, so I'm going to extend it by 10 minutes according to what we see on the agenda. So let's return in 20 minutes, whatever time zone you're in, I'm not sure. So in Tokyo time, we will return at 12:10, which is 11:10 in Singapore. Okay, welcome back. We will now have 2 further papers to complete day 1 of this conference. First paper will be by MD Al Amin Parvez, who's Assistant Director at the Central Bank of Bangladesh. And his paper is entitled Fintech and Inclusive Growth, Evidence from 25 Asian Developing Countries. I would like to invite Dr. Al Amin Parvez to go ahead for 20 minutes.
Thank you. So let me share my screen to start my presentation. Okay, so thank you. And again, good morning from Bangladesh as well as from Bangladesh Bank. So this is our presentation. Like we will like to present on the topic Fintech and Inclusive Growth, Evidence from 25 Asian Developing Countries. So these are my co-authors, like my beloved colleagues. I am MD Al Amin Parvez, and also with me, Ivanta Hashem Katha, Mashura Kabir Shaheba, and MD Sajjad Hossain. We all are assistant directors of the Central Bank of Bangladesh. And as well, we are working in the research department of the Bangladesh Bank. So let me start my presentation by saying some critical points on the topic. Like, first of all, why we have chosen this topic? So to rationalize our point of choosing this topic, we'd like to introduce that in reality, what we are seeing in the developing world right now. We have seen that the developing countries, mostly in Asian developing countries, they are getting fast development in the last few decades. Like they are having a higher GDP growth rate as well as higher infrastructures and others. But at the same time, income inequality and other types of inequalities are also rising to a great extent. We have seen from different studies, different reports, different analyses that income inequalities are on a rise due to at the same par of these development initiatives. At the same time, we are also seeing that a huge population of these countries are out of banking system, or we can see that there are a huge number of unbanked people in these countries. Many studies have shown that almost 50% or more than 50% of the people are still beyond the banking system facilities, or we can say that from the inclusiveness of the financial system, they are beyond this. So these are some basic problems of these developing countries. And at the same time, we are also seeing that fintech is on a rise of these countries in the last few years. And from my personal point of view, from my personal experience, I have seen that in the COVID time, when everything was closed in my country, in Bangladesh, with 180 million people, fintech was on a rise. Like people are started using the different types of financial services, mobile financial services, and others.
And it really changed lives of a million of the people in my country. When people couldn't get out of their home, couldn't do any business transaction physically, they started using these financial services, and it benefited a lot of people from a lot of aspects. So these things are like really beneficial for people. People are getting benefits from this stuff. At the same time, we have also seen that Asian giants like uh, China, Taiwan, Japan, they have used these fintech and financial facilities, financial services to a great extent. And following their footprints, like some other developing countries like Bangladesh, India, they are also trying to do developments in this stuff. So we can conclude that income inequality is rising. At the same time, fintech is also rising in these countries. So should we try to take a look on how this fintech or financial development is impacting the overall scenario of inclusive growth? We all know that inclusive growth is a major agenda of all the developing countries in nowadays. So from that point of view, we're trying to see how this inclusive growth is being accelerated through the fintech financial inclusion in these Asian developing countries beyond a country focus lens. Like from our literature survey, we have found that many researchers have tried to see that how these things are correlated, how these things are working all together. But most of the literature, most of the studies focused on some few country specific cases. So beyond this system, beyond this country specific lanes, we are trying to see a bunch of countries and to trying to see how these things are working. And at the same time, we all know that demographic dividend is a buzzword in these countries nowadays because we have a lot of population. We are trying to utilize our human capital as well to ensure a sustainable development, which is also tagged with our sustainable development goals. Like we all know that sustainable development goal 1, 5, and 10 are like closely related with this financial development, financial inclusion, and reducing income inequality. So from considering all these point of views, we are trying to see how fintech is working over the inclusive growth scenario. So these are few taglines of our presentation of our whole paper. Like we are trying to see inclusive growth, financial fintech, financial inclusion, macroeconomic factors, governance factors, as well as globalization. So from a literature review, we have found that financial inclusion have been studied over the how it's reducing the poverty and income inequality. Some studies also showed that it has positive impacts on decreasing income inequality. At the same time, some studies also have shown that it is not that much positive. It has not that much positive impacts over income inequality in some country-specific cases. At the same time, we have also seen that the inclusiveness of financial system, fintech, income inequality have direct influence through fintech on income inequality and other stuff. So many studies have been already done on this stuff. We are trying to take a broader look over the whole scenario, and we are trying to add some further knowledge, fresh evidence from this whole analysis. So the specific objective of our study is we are trying to assess or investigate the impact of fintech through different lenses. Like we have chosen major 3 lenses: financial development, financial inclusion, and institutional quality. From these 3 lenses, we are trying to see how fintech is impacting human development. So we have taken human development as a proxy for inclusive growth. We all know that inclusive growth has 4 factors. And among these 4 factors, except the environmental issue, HDI or human development can capture all the other 3 aspects. So from that point of view and from our literature survey, we have decided to take human development or human development index to be more specific as our proxy variable for inclusive growth. So to talk about the methodology, we have chosen the panel data analysis. And to do the panel data analysis, first of all, we have done some diagnostic tests and Hausman tests to decide whether we should run the random effect model or the fixed effect model. Then we have also done some model specification to run the whole data. So to talk about the data set, like we have taken the secondary data from World Development Indicators of the World Bank, Global Financial Inclusion Database from Findex of UN System, and HDI from UNDP, and we have also taken the World Governance Indicators data for our institutional quality data. So measures of inclusive growth, as I already told, that we have taken the Human Development Index of the countries, which value ranges from 0 to 1 to measure the inclusive growth. And our our data set have 25 developing economies of Asia, and our years of observation are from 2014 to 2021. So here is the description of the variables. Like I have already told the variables. We have dependent variables of as HDI, Human Development Index, and we have some other sets of variables. Like for financial inclusion indicators, we have taken 3 parameters from the global Findex dataset. We have taken the overall account holding of the people who are aged above 15 years, and we have taken the financial institutions account holding, like people over 15 years who have accounts in the formal financial system, like in banks or NBFIs. We have also taken the owning of debit or credit card to also include like in financial inclusion indicators. So in financial inclusion indicators, we have mostly 3 parameters: account holding, overall, account holding in financial system or financial institutions, and owing debit or credit cards. So our third parametric, like the group of variables, include the fintech indicators. The fintech indicators, we have taken the fintech, which is like people who made a digital payment, people aged above 15 years made a digital payment, the percentage of population, we have taken it as a fintech parameter from the global Findex dataset. At the same time, we have taken the financial development index, which is a dataset of the IMF. So financial development index has also been included in the fintech indicators. Then we have a set of control variables from the macroeconomic perspective, like trade openness, population growth, government expenditure from the consumption side, inflation, and GDP growth. At the same time, to see the governance issue or to see the institutional quality, we have taken the institutional quality parameter from World Governance Indicators. So it's the parameter which will describe as the regulatory quality. So it's also a World Bank dataset. With all the dataset, we have set this semi-log model, having HDI as our dependent variable in the left-hand side and all the independent variables in the right-hand side. So I already have discussed about the dependent variable and independent variable, so I shouldn't spend much time on this slide. Let me go to the analysis part. So here we have specified 6 different models with all our parameters. So from column 1 to column 6, we have regressed all our independent variables over the dependent variables like the Human Development Index. So let me describe from column 1. In column 1, like we have regressed digital payment, which is our index for fintech, over the Human Development Index. And we have seen that it's positively related, correlated with the Human Development Index, as well as it's highly significant. So from this, only this factor, we can see that with taking all the control variables of the macroeconomic factors, we can see that fintech can positively impact human development to a great extent with a great significance. Then we have we can go to our second model. We can see here that in column 2, we introduced the Findex indicator. That means from the IMF dataset, financial development indicator. And from the financial development channel, we can see that the fintech is again positively impacting the HDI or Human Development Index. At the same time, the significance is also higher. So we can see that through the passage of time, through the passage of financial development, fintech can be much more significant to impact human development. Then in model 3, column 3, we introduced the financial inclusion indicators one by one. As I already told, that we have 3 parameters to capture the financial inclusion. First of all, let me introduce the overall account holding of the people above 15 years. We can see here that account holding people over 15 years in the total population, percentage of people who are holding an account is positively impacting the Human Development Index through the fintech. So fintech is again positive, but the significance is not that high. Significance becomes a little bit lower. At the same time, when we introduce the account holding in a formal financial channel, we can see here also the relationship is positive between fintech and human development, as well as it is also significant. So just talking about these 2 parameters, like in general, in these 25 developing countries, we already told that almost half of the people are still out of the banking system, account holding system. So we can get an indication that a basic orientation over account holding in a financial system can increase the human development. So this is a like we can say this is a great indication, great signal. We can say that people, if they are introduced or oriented with the banking channel, banking system, account holding system through fintech, it can increase their human development. Then let me introduce the third parameter, like ownership of debit or credit card. We can see here that still the impact of fintech over HDI is positive and significant, but the parameter itself, like ownership of debit or credit card, is not that much significant. So it might happen that we all know that ownership of debit or credit card is not a thing for all people. Like in these developing countries, there are many people who are not that much literate, or you can say who are not that much financially literate. So they might not that much user friendly or that much confident over the ownership of debit or credit cards. So in that case, we can see that increase of ownership of debit or credit card might disproportionately impact the overall population. Like it might disproportionately impact the human development through fintech. So finally, when we introduce the institutional quality as our governance indicator in the column 6, we can see here that the significance of the fintech over HDI has increased a lot, like similar to the column 1, when fintech was the only variable to impact HDI. So when we have introduced the governance indicator like institutional quality, we can see here that the significance has increased, as well as the value of the parameter, that we can see that the degree has also increased. So from here, we can conclude that we all know that we in our developing countries, we have a big issue of regulations. We have like many loopholes in our institutions. So we can see here, if we increase the institutional quality, like many loopholes of institutions might be eliminated. At the same time, our corruption might get lower. So through this way, we can have a better impact over the human development. That our main parameter, what we are saying, that fintech may have a better impact over human development if institutional quality can be increased. So we all know that institutional quality is also a crucial thing. Like to increase the institutional quality, we should have a better institutions. At the same time, our institutional strength should also be higher. So it is very much related with our political system, overall governance system. So we can say that by only increasing the institutional quality, it will impact the human development. But we can like at best, we can be very much optimistic that if we have a good institutional quality, at least in the financial system, then our human development might increase. And we also know that the issue of like different types of illegal activities, like financial intelligence issues, are also emerging in these countries, like money laundering and others. So if we can have a better institutional quality, we can also decrease these loopholes, decrease these problems, lowering these issues, and we will have better impact of fintech over human development. So if we conclude all the analysis part, we can see here that fintech have a better impact over HDI in different channels, like through financial development, through financial inclusion, as well as in governance side. At the same time, we have seen that the degree of impacting, like how much fintech is impacting HDI, might vary. At the same time, the significance is also higher. But we can see here the variance of degree due to like some measurement issues, like the data of fintech we have taken from the data set. They have some like different measurement issues. That might be a cause that the degree is changing from different channels. So we all know that Findex is a data set for all the countries. So at the same time, if we can have a different data set of Findex for these developing countries, the result might be a little bit different one. So from all this analysis, we can conclude a few points. Like in our conclusion, we have also shown that fintech has a substantial positive impact over human development through different channels. As I already told, we have chosen 3 channels, and we have also seen that the impacts are positive, that fintech is positively impacting human development through varying degrees and varying significance. At the same time, we can also see that financial development can also impact our better economic condition, better livelihood, better livelihood, as well as better financial knowledge. That will also yield a better human development. At the same time, we can also see here that better institutional quality play a significant role. At least we can say it's a positive role for human development. At the same time, I have also discussed how the better institutional quality can impact human development through fintech. So these are the conclusion from my side. So let me talk about some limitations, what we can do further to improve this research, and I will expect with all my colleagues, we will expect feedbacks from you to solve this limitations problem to a great extent. Like our data set, we can increase the data set from both countryside to time side. Like we can increase more countries, we can increase other developing countries include, or at the same time we can increase our time frame to have better results. At the same time, a good type of instrumental variable, or to introduce a good IV, will increase the capacity of analysis in this part. At the same time, we can also introduce some advanced analysis like GMM model, difference DMM, and other stuff to have some different analysis, to have better analysis or deepening analysis. This is all from my side. I will expect a good feedback, good discussion on this from you, and we will expect a lot from all the discussion to improve our analysis. Since we have started our central banking career just about 3 years, so we are here to learn a lot from apart from our all this analysis. So thank you from our side, and thank you.
Thanks very much, Dr. Al-Amin Parvez, for an excellent presentation. Also very punctual, finished perfectly on time. You found very robust results across the impact of digital payments on the HDI. I think one thing from my perspective, just a quick comment, would be to look at some interactions. So how does institutional quality affect the impact of digital payments on HDI? So some interaction terms might shed some light on that. Anyway, I would now like to turn to the discussant of this paper, who is Professor K.P. Prabish of the Indian Institute of Technology at Hyderabad. So Professor Prabish, go ahead. Thank you.
Yeah, thank you, Dr. John, for inviting me to this paper to discuss. First of all, I thank Parvez for a very good discussion, good presentation. It was really very well done. Then I got more information from your presentation as compared to the paper. So this is my slide here. Yeah, is it visible now? Yeah.
Looks good, yes.
Yes. Yeah. So this is the summary of the paper. This paper examines the impact of fintech on inclusive growth in developing economies in Asia, 25 countries, using data from 2014 to 2021 and employing panel regression technique. The study finds a significant and positive impact of fintech on inclusive growth. The presence of financial development variable in the model reduces the impact of fintech on inclusive growth. However, the presence of institutional quality improves the significance of the fintech on economic growth. So my overall comments is on this paper. This is an interesting paper. However, if you want to target this paper into a journal, then a slightly better, revision is required, a substantial revision from my perspective. So my comments largely on how to improve this paper in a journal format. So this is how I arranged my specific comments. So when I look at the introduction part, I still believe the motivation is yet to be improved, as a significant improvement is required in this section, especially the concept related to financial technology is not well discussed there. Rather, financial development was discussed, but the fintech is not well discussed in the introduction in detail. So it is important for a reader to understand how technology and finance are driving the inclusive growth. So I think, that perspective, we can start the discussion in the introduction so that this can be well communicated to the reader. Then how does fintech is differ from traditional finance? And that issue also not discussed in this introduction. So I think that is quite, if you look at it, there are a lot of literature related to the benefits as well as risk of fintech. So for instance, you can get the literature on P2P finance, then how does transaction cost, reduced due to fintech and information asymmetry related issues. And these are all positive side or benefit of fintech. At the same time, there are literature which suggests that there can be a disruption of existing finance due to the presence of a fintech as well. So I think it is important to have both the literature, both argument in the introduction, so that the readers will get a good idea about the fintech onward. Then, is there any evidence from the advanced economies on the impact of fintech on growth? Then what drives the inclusive growth in those economies? Does fintech help there? So these are the probable to use to motivate the issues. Finally, it is important also to discuss the need for fintech in developing countries in Asia. Why fintech is required at this moment, or you need to really motivate the research question by addressing this. So, moreover, it's also important to show the trends in fintech in these economies, Asian economies, developing countries, and the number of startups and their usage, etc. There are quite a lot of literature related to. So, then you can talk about the link between fintech and inclusive growth. I think if we could write in this angle, so that more paper will be more appealing to a reader. And coming to the literature, I still believe that research gap and contribution is not well discussed in this section, especially the theoretical argument of how technology affects the growth. Then you can have some discussion about neoclassical and new growth theory, etc. That how that connect the technology and growth. Then when finance come in, then financial technology come in, then what kind of model you are expecting, then how this model can be augmented. And I still believe there are quite literature in this area. Then in that way, you may probably classify the literature section to three parts. This is my suggestion. And financial inclusion and inclusive growth, or inequality. Then fintech and growth, and fintech and financial inclusion. So that the readers will get broader understanding about the existing literature. And then you can discuss the research gap and contribution to the existing literature. And coming to the specific comment on data and the econometric methodology, I think still the theoretical link between the dependent and independent variable should be explained through the literature. That's still not clear. So especially the channel through which the fintech affect inclusive growth, that is not well written in the paper. So as Dr. John already mentioned, that there can be interaction effect that is not tested in this paper. So you have included the three sets of variable here: financial development, financial inclusion, and institutional quality. So on these three sets of variables, then how fintech is going to affect the FDI or inclusive growth, that interaction is not well written in this paper. So could be, this interaction effect can be tested if with the supporting theory or arguments. Again, there could be a financial variable measurement issue related to inclusive growth. I think, there are existing literature by even ADB paper already. They came up with a new multi-dimensional index, McKinley's 2010. So you could use those, index, or you can construct the inclusive growth for this country. Then you can probably test instead of the simple the index used here, HDI. So that is look like a crude index to capture this. Again, coming to the econometric issue here, that there could be an endogeneity or collinearity issues related to your fintech and financial development, because one of the papers previously discussed, fintech could affect the could lead to financial development. So there can be a collinearity issue as well. Then so probably you can present a cross correlation so that this can be addressed. And if there is a cross correlation, how this can be tested in this solved econometrically, that can be again an issue. So then again, as you mentioned already, that COVID-19 has a significant impact on fintech, and people started using fintech, mobile payment drastically during COVID and post-COVID time. So how your study captures that COVID-19 impact? So that is another question. Econometrically, you can do some exercise if you wanted to expand the data, dummy variable, etc. Again, coming to the issue, the robustness test, the panel GMM, probably, you can look at how to address the issues related to endogeneity, etc., or any other alternative technique. Coming to the point here and findings and conclusion, as when I read the paper, it can be seen that the most of the estimated coefficients are too small and difficult to interpret. I believe there could be due to the measurement of variables. Because you use the HDI, Human Development Index, the values very, very 0 to 1. Then some of the government expenditure value in absolute terms. So there could be, this can be due to variable measurement. So you may probably convert this variable into logarithmic form, and then you can try. Then you may get a better result. And another issue with the empirical finding part is none of the control variable is statistically significant in the model, especially GDP, even GDP growth in driving this Human Development Index. So obviously the question comes to our mind of what drive inclusive growth in this economy. So this is another point that needs to be looked into. And you could probably, report some of the statistics related to the model, R-square and Haussmann test statistics, etc., in the table itself. Then again, in conclusion, you mentioned that direct and indirect impact of fintech on inclusive growth in different channels. So all these channels are not well discussed in the paper. And I think these are the channels you need to use the motivation part. Then in the presence of financial institution quality, how does fintech is going to impact human development, etc. So I think this is three channels or the presence of three group of variables, then how this is going to affect. So I think that is quite important, and this needs to be discussed or articulated well in the introduction. Then conclusion and policy recommendation should be precise, should be based on the empirical findings. I think this is overall, the remaining references I used it. Yeah, thank you, Dr. John.
Thanks very much, Professor Pravesh. So a number of comments there. I think the research objective of the paper is very clear, but there are possible improvements that could be made on the econometric side. So I would like to give you the opportunity to respond to the comments for the next 3 minutes or so, Dr. Al-Amin Parvez, and then we will move on to the next presentation given the time. So please go ahead for 3 minutes.
Okay, thank you, John, for giving us the time. So firstly, I should thank Mr. Pravesh for your excellent comments. So we believe that this is the way we should interact with the academicians, like from the practitioner part, from working in the central bank. I think sometimes we are become a little bit result oriented. We are not focusing that much the way we are passing through to get the result. So I think it's a great addition. Like you have given us excellent comments over specific points. Which I believe if we include all the points in our paper, it could be a good journal article as well. So thank you again, Mr. Pravesh, for your excellent comments. So to address the other comments, like as I have already discussed, that we are trying to see the impacts. Like we are trying to see what is the signal? Like, is there any indication of improvement of human development through fintech? So to give a signal, like we can say that it's the beginning of the beginning. Like we are trying to show some indication to do some further research, to do some further work with accommodating some further analysis or advanced techniques. So I believe that we will work on this further, and with the help of other and the comments, we can improve this paper, improve the analysis, and we can have a better outcome of the whole analysis part as well. So thank you again. I think if there is any question, we can address also. Thank you.
Thank you very much. We look forward to receiving your revised paper based on the comments received, and I think it would be an excellent contribution as a result. We will now move on to the final paper to be presented today, which is by Shigehiro Shinozaki, who's a senior economist at the Asian Development Bank in Manila. And the title of his paper is Russian Invasion of Ukraine and the Impact of Digitalized Small Firms in Central and West Asia, Evidence from Rapid Surveys. Please go ahead, Shiga, for 20 minutes. Thanks very much.
Okay, so because of these time constraints, I try to explain these all the things as much as possible. Okay, so good morning. So thank you very much for giving me this opportunity to talk about this impact of the Russian invasion of Ukraine on digitalized small firms in Central and West Asia. This is the result of these rapid MSME surveys. So we conducted in July to August 2022. So in 7 Central and West Asian countries. So namely, Armenia, Azerbaijan, Georgia, Kazakhstan, the Kyrgyz Republic, Tajikistan, and Uzbekistan. So actually, the large impact on businesses have yet to appear. So 6 months after the invasion, but so I could see some critical changes in business environments of digitally operated small firms. So taking this opportunity, so I'd like to highlight some key findings from our study. Okay, so now let's start. Okay, so just quickly, so similar to other countries, Central and West Asian economies were adversely affected by this COVID-19 pandemic. Actually, the sharp drop of GDP growth in 2020. So, but as you see, recovered shortly in 2021, supported by intensive government assistance measures. So, however, the recent Russian invasion of Ukraine negatively affected the growth momentum of the regions with increasing inflationary pressures. So as Russian Federation was a major trade partner of most Central and West Asian countries, the recent Russian-Ukraine conflicts affected the region's economies as well as their business operations, including MSMEs and also digitalized firms seriously. Okay. So when looking at this response of Central and West Asian countries to Russian invasion of Ukraine, so 2 country groups can be identified. West Asian countries, so with no anti-crisis plan, so represented by Armenia, Azerbaijan, and Georgia, and Central Asian countries, so with a set of action plans, so including the Kazakhstan, the Kyrgyz Republic, Tajikistan, and Uzbekistan. So in general, so West Asian countries have relatively well coped with the invasion impacts and the related sanctions. So hence they had no comprehensive anti-crisis plans at the time of the survey. They could partly benefit from these sanctions. For instance, increase of tourists from Russia and Belarus. So increase of the new bank accounts in accordance with these relocations of Russia-based firms to the region, and also increase of national revenues from oil and high prices, and so on. So there are so many issues there. By contrast, Central Asian countries had adverse effects from these invasions and the sanctions. So thus, they initiated anti-crisis plans, so addressing the 3 pillars, so food security, social protection, and so business and employment support. So especially so micro, small, and medium-sized enterprise support. So firms in this country groups faced this sharp drop of foreign trades with Russia, supply disruptions of so imported foods and so commodities, and sharp decrease of inward remittances, for instance. So just before starting this analysis, I just categorize roughly these two country groups for the analysis. Okay. All right. Okay. So to see this real impact on small firms, so as mentioned, we conducted this rapid surveys, so in 7 countries. So because the sample size was actually different by country, so we used the pooling data. So for analysis with 2 country groups, so that have different impacts as mentioned. So the analysis focused on this impact by firm size, comprising 2 broad categories, saying that these micro and small firms, this is one category, and another category is medium-sized and large firms. And also, we use these 3 broad categories of sectors, agriculture, manufacturing, and services sectors. And by country group, as mentioned, Central Asian country groups and also West Asian countries group. So basically, so in my analysis, we use these broad categories for analysis, especially for the regression analysis. So, okay. Actually, all right. All right, so this study uses a linear probability model. So actually, so there are so many, analytical models, but I choose linear probability models because it is very convenient to understand the interpretation, and also not so much different from these non-linear models. So then this, in my paper, so I use the linear probability models to estimate the impact of Russian invasions of Ukraine on digitally operated firms. So addressing micro small firms. Okay. So actually, as we use the online surveys approach, so samples were not actually randomly selected. So we prioritized the urgency of this survey. So and follow these non-standard sampling procedures. This is actually not good sets for the analysis in regression. So, but because of the nature of the online survey and also rapid surveys, I tried using this data. But also the pooling data, because as I mentioned, the sample size was different by country. So I used the pooling data for analysis with 2 country groups, as mentioned. Okay. So having said that, to understand the extent of the bias, definitely the distribution of this unweighted survey data was compared with these existing frameworks of national statistics. So this is very important to understand. Actually, so I saw some underrepresentation in micro and small firms and also services firms. But on the other hand, overrepresentation in local MSMEs. But this should be taken into account for interpretation of this result. This is the regression models, but because of this time constraints, I don't want to explain the details of this model, but just simply saying this. So linear probability model, so in my model, so considers 7 core factors affecting the MSME operations. So saying that the industry sector and also region, so capital city or outside region, and operating periods, so decentralization in operations, and also ownership of the company is so gender issues, and also global business exposures, and so farm size. So based on this employment grouping. So I also added this one binary country group variables. So as mentioned, so two groups, West Asian countries groups and also Central Asia country groups. So as it's also added in this model. The model estimates the impact of 4 areas of MSME operations. It's denoted by Y. So sales revenue and wage payments, so finance conditions, and so employment conditions like that. So also, under these 4 areas, more details of 6 subdimensions, so included in this estimations of this model. Okay. So, there's 2 types of estimates. So I conducted. So first model is about to estimate this more overall impacts. So micro, small, and medium-sized enterprises. So including these dummy variables of digitalized or not digitalized. But the second one was just focused on this digitally operated farms. Digitally operated farms actually defined as farms engaged in online selling of goods and services or e-commerce. So which accounted for actually not so big in this survey data. So, but taking this opportunities, I'd like to quickly overview these survey profiles. Okay, so in this rapid survey, we received total 903 completed responses from farms in 7 countries, which accounted for around 28% from West Asia and 73% from Central Asia. The majority of samples were micro and small farms. So 48% came from services and 33% from agriculture and 90% from manufacturing. And so samples included 26% from internationalized farms or exporters and importers. So digitally operated farms actually not so big numbers we received, unfortunately, which accounted for just 19.4% of total survey respondents. But based on this data, we try to analyze these impacts as compared to these non-digitalized farms. All right, so this is the survey result. Business environment. The surveys found that the digitally operated farms faced very much different issues. But change in business environment was more pronounced in micro, small farms, negatively affecting the 36.6% of digitalized MS micro, small farms, and 12.8 percentage points higher than non-digitalized micro, small farms. So this could be because large shares of digitally operated farms are internationalized. So which means those participating in global supply chains or trading in exports and imports with Russia. So more concretely 44%. So then these micro and small farms surveyed. So included here is so much internationalized. Okay, so this is the estimation result of this linear probability model. So I picked up this overall impact and also specific impact on digitally operated farms. So I included the brief explanations of linear probability models results. So in the following slides. So because this is very details. So I don't want to explain the details in this presentation slot. So later, you can see my actual papers. So more detailed explanation is there. So for this revenue, the linear probability model, so as indicated, as shown in this previous slide, showed so many business sectors, including the manufacturing and water supply, construction, wholesale and retail trade, and also transport and storage. So faced sharp revenue losses after the invasion started in February 2022. So digitalized micro small firms could avoid having no revenue or temporary closures, closings of a business. But as many trade internationally, they have to deal with the higher income losses. So this lets them more likely to lay off employees to save costs. That is the results of these surveys. And also there were two groups identified 6 months after the invasion. So as you see, so MSMEs capturing the business opportunities, and also those adversely affected by this invasion and the global sanctions. So these two roughly groupings, so we found from the survey and also LPM analysis. So for the employment conditions of the surveyed firms, at the time of the survey, so most micro small firms reported no change. So in working conditions, actually, 63.4% of digitally operated micro small firms. So saying that these no change. But nonetheless, some tried reducing the operating costs by reducing the working hours and also allowing the work from home arrangement. So especially digitally operated micro small firms. And this kind of these, work adjustments, they tried. So even after, only 6 months after the invasion started. So some micro small firms try to increase these employees and also reduce the increase, but it depends on their profitability. Some captures these benefits from this invasion. So for instance, these tourism sectors or ICT sectors, for instance, in Uzbekistan like that. So some Central Asian countries, for instance, Kazakhstan, so heavily relied on these imports from Russia and foreign trade with Russia, and also some small farms in Kazakhstan used the bank account in Russian-based banks. So then the impact was so different and also so much different. So I could see, but as I mentioned earlier, I used this pooling data. So then this only this difference of this impact. So I identified in this Central Asian category and also West Asian categories. But I could say some adjustment of the workforce appeared in Central and West Asian countries. Okay. So I already touched upon this, so I just skip this. The financial conditions. So regarding the financial conditions of surveyed firms, so linear probabilities on model estimates and also survey findings indicated that micro, small, and medium-sized firms faced a difficult financial situation, either out of cash and savings or running out in 3 months from the time of the survey. So more pronounced in digitalized micro small firms and also agribusinesses. And about the funding conditions, so 1/5 of the digitalized micro small firms had access to bank credit, but as you see, so many still relied on these own funds or retained profits and also funding borrowings from family, relatives, and friends like that. So still, many parts of these, even digitalized firms rely on informal funding. And digital finance has yet to be well accepted, as you see in these figures. So even when those already digitalized, you tried using these very traditional funding ways, including informal fundings. So then these issues is so how to so make them so utilize these digital financial services to fill up so their unmet financing demands. So amid this very much crisis situation right now. So there was some unknown risks there. So they don't know this or how to use this technology. So like digital finance platform, how to get the money from the platform. So this kind of these very basic informations they don't know. So then this some support from the government and also private sector communities needed to support them connecting to the digital financial platforms, and also so they need some more training and basic knowledge on digital finance literacy. So there's so many literacy issues still there. All right. Our survey also monitors these concerns and the obstacles MSM is considered. And then so there are several mixed results. But there's some most important things. So given this prolonged invasion impact, the very much the top concerns of digitalized micro small firms, and also including the digitally operated services firms, was a decline in purchasing power of people. So also there's worrying about the second sanction risks. Because there's now these many Russian-based firms, Belarus-based firms, so coming into the Central and West Asian countries, and so they started opening the bank accounts there, and then some countries worrying about this risk of this secondary sanctions. So this is also one of the issues. So micro small firms concerned, especially digitalized firms.
Could you conclude, Shiga, please?
Okay, so quickly, sorry. So there are so many things, and then I just skip these few things. Okay, there actually not so much difference between the digitalized firms and the non-digitalized firms, but the tax relief. The corporate income tax deduction or something, so they still need to get it to survive during the difficult time, especially these ongoing invasions impact. So this one was actually followed by streamlining government transaction process and shift to digital platforms, and also improved the ICT infrastructure and regulations for internet speed and low cost. Still, many MSMEs, especially the digitalized firms, need more support from the government, especially these ICT infrastructure issues. And this one was also financial related matters. Still, concessional loans were highly desired by firms. So regardless of the digitalized or not digitalized. The support needs for alternative finance and also digital financial services were identified. But as you see, in the middle of this chart, not many that's high ranked because of these perception risks still there. So then this needs to provide some more right information and then guidance to these MSMEs, even already digitalized. So to develop these more digital platform, online selling, and digital e-commerce businesses, as well as the access to digital financial platforms. Okay, so I just, this is a summary of the key findings, but there's because of the time constraint, I skipped this. So just please check later. Okay, so this one is also the chart. So please check later. All right, so just simply, I wanted to say four things. So for the policy implications to promote more this business digitalizations, so for micro, small, and medium-sized enterprises, and also including this use of promoting the use of digital financial services. First thing, strengthen domestic commodities markets through business cluster development. So this is very important because as you see, the linear probabilities models of firms that the international firms face sharp revenue losses, as mentioned, force them to lay off workers and to cut wages. So, but once they can access these more appropriate growth capital and the working capital financing. So through this more diversified financing, they can more easy to manage everything. And also they need to more focus on this domestic commodity markets because this are now very costly to import the raw materials from Russia and the other countries. And then still ongoing global supply chain disruptions, and then strengthen domestic commodity markets through making the business cluster is a very key policies pillar across these countries in Central and West Asian countries. So related to this, of course, diversifying to exports. So using the national branding strategies is also the key. So diversifying these partners of these trading, of these SME product and services, it's critically important. So strengthening their branding. So governments need to support their branding. So this is one of the message I would like to stress. And also assist this MSME digital transformation by promoting the use of technology in operations linked to entrepreneurship development. Because most of these MSMEs, as you know, stability oriented, distributive trades, or just selling the goods to survive only one day or something like that. So owner's mindset is critically important to be changed. So to be involved in this more growth-oriented base of these enterprises at the national level. So to this end, digital transformation is one of the tools, areas to be promoted further to create this base of the entrepreneurs and growth-oriented firms. So then I would like to stress developing this more entrepreneurship base at the national level is critically important. So, and lastly, diversifying the alternative financing options by developing market-based financing and digital financial platforms. This is fundamental. So everyone understands, but this is still needs to be stressed. Because most of, as mentioned in the survey's findings, most of these MSMEs, even digitalized MSMEs, they still rely on the informal financing and own funds. So then these also tried to access to bank credit, but only in the conditions of support from the government. So they need to access more diversified financing options, including digital finances platform. To this end, so government and the private sector communities need to provide some more financial education, literacy programs to viable MSMEs. So digital finance is still needed, and then many demands are there. But as mentioned, perception risks are there. So to improve this situation, so I'd like to stress these four policy.
Okay, thank you very much, Shiga, for a very comprehensive presentation. I think you've presented a vast number of survey findings. Potentially an overload of results would be my initial impression. I think it would be, even though you say that digital finance hasn't been really taken up to a great extent in the region, it would still be interesting to pull out from your results to what extent those that have adopted digitalized processes or taken on digital finance have been more resilient to the shock than those that did not. This would be a more clear research question, and it would also lead to more clearly derived policy implications, because I think you've provided an assessment of a huge array of results. So I think it would be good to distill it to a more clarified research question. And also, of course, taking into account the weaker external environment. So looking at how economies have reacted 6 months later needs to control for the weaker external environment. So I think that's an important point as well. But anyway, let's move on to the discussant because we're a bit beyond the time already. So the discussant of this paper is Zana Kapsaliamova. Hope I pronounced it in a decent way. Kapsaliamova.
Yeah, Kapsaliamova.
Okay, thanks. Who's assistant professor at Nazarbayev University, Kazakhstan. So please go ahead. You have 8 minutes, I think it is. 8 minutes, yes.
Thank you so much. Just one. Okay. Can I share my screen now? Okay, yes, I can.
Yes.
All right. Thank you so much for inviting to a very interesting conference. It was a great pleasure to read the paper by Professor Shigehiro Shinozaki. Thank you so much for writing a paper on a very hot topic on implications of Russian invasion of Ukraine and its impact on businesses in Central and West Asia. It's indeed a very interesting study as it shows first-hand results on the effects of such a shock on businesses in the region. I enjoyed reading the paper a lot. The paper focuses on a group of firms that are classified as micro, small, and medium-sized enterprises. The paper shows that Russia-Ukraine conflict generated some growth opportunities for some countries, but at the same time presented risks for their future development. The paper pays specific attention to the two groups of countries, West Asia, Armenia, Azerbaijan, and Georgia, that didn't have anti-crisis plan, and also some countries in the Central Asia, Kazakhstan, Kyrgyzstan, Tajikistan, and Uzbekistan that have implemented some anti-crisis plan due to the shock. And the paper tries to see how the shock, such as Russia-Ukraine conflict, affected the businesses in these regions. The paper applies as a methodology linear probability model. And one of the main caveats of this paper, as it's also stated in the paper, is a sample selection bias, as due to the nature of the survey and due to the some implementation steps that the paper went through. Let me go to the comments that I see relevant. First of all, I would like to draw attention of the author to the identification issue. It will be great to distinguish the effects of the prolonged COVID recession from the shock related to the Russian invasion. The shock of the COVID recession still is faced by many firms, and it will be great to see to what extent the new shock had the impact on the firms that are contacted as compared to the COVID-19 recession. Most likely, the shock has a bigger magnitude, and you could already see that in the data. But it will be still great to see to what extent that shock is of such a great size as compared to the prolonged effects of the COVID-19 recession. I think it will be also in that sense to distinguish between the effects of lockdown policies that had affected businesses severely from the policies related to the Russian invasion, because to me, the policies that are related to the Russian invasion were rather macro based, and those lockdown policies are micro based that restricted the movement, and that's why it had a more impact on the firm. So it would be really great to see this splitting apart, so that one could follow where it was what was due to the one shock and what was due to the other shock. In your paper, you measure the effects of sanctions that clearly should have an impact on the countries that have a strong trade or large trade between with Russia and Ukraine. We are all very much connected due to the historical ties and also due to the current situation. There are papers such as Sedrakian, one of the most recent ones, or Dreger, that try to measure the impact of sanctions by constructing indices connected to the amount of the trade flows between the partners. So it will be good to see to what extent the effects of sanctions are there, and how do firms really face those, because that's I think of major concern to businesses in the region. The paper applies uses the pooling data because of the cross-sectional nature, but maybe it will be good to repeat this survey sometime in the future to ensure that the results are robust and apply panel data, so that you could really track the firm that have responded and then see the impact of the shock in the let's say after 6 months, because in this it would also help us to distinguish the effect of one shock from the other. Would be great to see the different diagnostic tests, for instance, whether there is a heteroscedasticity data, and you have already mentioned that there is sample selection bias. Maybe one need to run proper tests and apply maybe two-stage regression like Hausmann selection procedure or something like that. Then maybe it would be good to do some robustness tests and try to run the same model using alternative methodologies such as Probit, Logit models to ensure to what extent the results are sensitive to different methodologies. The other comments that came into mind when I was reading your presentation and while also reading your paper is if you could also see the economic significance in addition to the statistical significance, either in terms of the standardized beta coefficients or some other means that could be used to show to what extent some particular parameters that you are looking at in the paper are of really economic, of how to what extent they're economically significant. And also in terms of the minor might be comment regarding the readability. I see a lot of graphs, lots of numbers. Would it be possible to group them and then maybe present the most relevant ones in the main paper and then move the details in the appendix? Because when you read the paper, you kind of get lost as there is so much information and it's a little bit hard to navigate and distinguish one thing from the other, and just to kind of see what are the main messages of the paper, because there's so many things at the same time. So maybe it would be good to a little bit kind of restructure and enhance the readability of the paper. Just but that's a reminder, because your paper is really rich and there's so many interesting insights. So yeah, so it's really a very good contribution. That's all from my side. Thank you very much for your attention, and thank you very much for writing a paper on a very interesting subject. Thank you.
Thanks very much, Anna, for excellent comments, both on the econometric side as well as on the presentation side. As I actually agree with you on that point. There's a lot of information in the paper, and some of the material could be put into an appendix, and this would bring clarity to the main message of the paper. So I would like to ask Shiga to spend 3 minutes to respond to the comments of Zana. I don't see any questions in the chat, so I think we can close the session after your response to the comments. So please go ahead for 3 minutes.
Thank you, John, and thank you very much, Professor Zana, for the very much insightful comments. I actually totally agree with your point. Actually, I understood by myself these points you raised here. So we had dilemmas to use this pooling data and also this online survey data. So definitely, we need to follow these standardized standard, sampling frames to estimate this kind of regressions. So having said that, because this is a rapid survey, and then this is a one-shot survey. So we got cooperations with these government authorities and the private sector communities. So then please allow me to use this pooling data for these studies. But definitely, I need to address these important issues to be improved for the future studies. So on this data set, and also for these methodologies. So and also robustness check. Actually, I didn't mention in these papers, but I also conducted these probit modelings. The same as if not mistaken, the results of the estimates are very similar. That's why I just picked up these results from this linear probability model. So, but maybe in my paper, I need to attach this result of the probit models. Should be included as attachment. So thank you very much for this point. And also literature review still very limited. But you read some articles. So maybe I need to review these materials. And then if appropriate, would like to include these literature review sections of the paper. Okay. All right. And other things, still so many issues to be improved, including these, modeling of these estimates and also data selection like that. But overall, just I checked this overall descriptive analysis from this survey result, and LPM result actually is similar to the descriptive analysis. And then, if I include this result from this probit model, and then I can, to some extent, explain the overall trends of these impacts on decentralized small farms in my paper. But definitely, some improvements need to be stressed at the end of the paper. Thank you so much.
Thanks very much, Shiga, for these comments. Yeah, we look forward to receiving your revised paper based on these comments. I think it would be a very strong contribution to the literature. So that concludes the first day of this conference. Thank you very much to all of the presenters, discussants, and other contributors. I think we have learned a great deal about the role that digital payments but fintech in general has had on financial inclusion, and as well as that on improving the resilience of firms to shocks. Tomorrow we will go a little bit deeper into digital payments and also central bank digital currencies. So we look forward to that. The session tomorrow is in the afternoon, so it will commence at 2:30 p.m. We will have some speakers from Europe, so we account for that by having a later session in Asia. So we hope that you can join us tomorrow, as it says on the slide here, perfectly timed. So yeah, 1:30 p.m. Singapore time tomorrow, and have a good rest of the day. Thank you very much.